Founding a company isn't easy and often expensive. You don't only need to cover the living expenses of you and your team, but also all the costs related to product development and scaling. But where should you get that money from? And there's another problem. 90% of the startups fail, and because of that you can't just go to a bank and get a loan, because for banks it's too risky to invest in startups. There are still options left. There are two terms in the startup world: bootstrapping and venture capital. What this is and what are the pros and cons of these two, that's what we discuss in this video. So let's take a look at the two terms. First, bootstrapping. Bootstrapping means that you build your company without external funding. To do this, you need to keep your expenses as low as possible and be very cost effective in building the product and scaling the product. Often founders still have a part-time job, and in their free time they develop the product and scale it. As soon as they make enough sales to cover the living expenses, they then switch full-time to their startup and then try to scale it further. And many startups go this route, even if it seems like every startup is getting venture capital. And that brings us to the next term, venture capital. Venture capital is very deeply connected to the startup scene. Startups that are designed to raise money are also designed for large growth. Companies that are designed for growth can reach valuations over millions or even billions of dollars. You can see this in internet startups like Facebook, Slack, or Zoom. If investors have bought shares of these companies along the way for just a tiny fraction of the valuation that they have today, they have a big return on their investment. As an extreme example, let's take a look at Facebook. The first investor of Facebook was Peter Thiel. He bought 10% of the company for only $500,000. Okay, 500,000 sounds still a lot, but at the Facebook IPO in 2012, Facebook's valuation was $100 billion. So the 10% that Peter Thiel bought for 500,000 was then worth $10 billion. Of course, this is a very extreme example, but investors calculate that 9 of the 10 startups fail, so the one startup that doesn't fail need to give them returns that compensate for the losses they made with the other 9 that failed. And also an important side note for founders would be that the money you take, you don't have some kind of private liability for that. Investors invest in the company and not in the person that is behind the company. If the company fails, you don't have to pay back the money. Investors know that, and investors calculate with that risk. And for venture capitalists, you can distinguish between two types of venture capitalists: business angels and VC firms. Venture capitalists that invest in a very early stage in a startup are also called business angels. Business angels are wealthy individuals who are very connected to the startup scene and invest in startups at a very early stage. In Europe, normally from business angels you raise around 50,000 to 200,000 euros. And often business angels also support you beyond just giving you money, but also give you support and network. At a later stage, when you need more capital, you go to VC firms. VC firms manage bigger funds and try to make a good return for the institutions or family offices that gave money into these funds. And the goal of the startup from the investor's point of view is always an exit. An exit could be an IPO, but an exit could also be when you sell your startup to a bigger company, for example Google and Apple, and investors can then liquidate their shares. Now that we have an overview what bootstrapping and venture capital is, let's see what could be the better option for you. And as you would have guessed, both options have their pros and cons. But first, you don't always have both options. Bootstrapping is great when you can build your product in a very cost-effective way. For example, you're building an app or you're building a software as a service product, and you don't need that much funding or that much money to build the product and scale the product. But not every product is like that. For example, the startup Boom, which are building supersonic airplanes, They need a lot of money to build their first products and then also to scale them. If you build an app or a software as a service that doesn't have the potential to become a billion-dollar company, or you don't want it to be, but it's totally okay, your startup then isn't in the best position to attract venture capital. But if you have both options, getting in venture capital is a good option for founders to fully concentrate full-time on their product, building it, scaling it, and really following their vision and make the best startup as possible. The downside, of course, is that you give shares to individuals or institutions whose sole interest it is to grow their own investment. In my opinion, the best way for a startup is to keep an eye on profitability from day one, but also think about how an external investment could grow or accelerate the growth of your business. Also, if you don't depend on getting the next investment, your negotiating position with investors is much better. If investors see that you're building a company that's going to be very big in the future and you don't necessarily need the money, investors will provide you with money to terms that you can't refuse. So that's my take on venture capital versus bootstrapping. Think about what kind of company you want to build and what's the best way to go. And what do you think? Would you rather go with venture capital or would you like to bootstrap, and why? Please write that in the comments below. See you in the next video.